This is the first downstroke that we've had really since January, February of 2016, and they're to be expected after this run that we've had. And really what I think is happening, it's time to embrace new strategies. To me, the market leadership has changed, and you've got to look at things like Verizon, the consumer staples, some REITs, Simon Property Group, even utilities, Philip Morris. Those are now coming back into view, and it's a regression to the mean situation. And certainly expecting a correction in this time is automatic. We've been way too long before we've had some type of an adjustment to the high flyers.
So you're tilting away from some of the market leaders and towards more of what we would call value stocks, right, Chris?
Absolutely. I mean, value managers have skinned their knees a bit this year. And even earlier mentioned the financials is another area that I think is due for a turnaround on it. And now I think they're coming into view. So embrace the new leadership is my words on that. Absolutely.
So, David, let me ask you, I mean, a lot of people are pointing to a variety of factors contributing to this sell-off, the midterm elections, trade, but certainly interest rates are a big part of it. But here, the Fed has been signaling what they were going to do for a very, very long time. Why does that seem to be so upsetting now to equity investors?
Frankly, Tyler, it's because the Wall Street has taken too long with its head in the sand to recognize just what the Fed has absolutely told us, that they would be tightening, that we were in negative real Fed funds, most intense monetary stimulation we know. You cited some great statistics. I'll add one more. At about noon today, the average S&P 500 stock was 19%, real close to 20%, off its 52-week high. When that happens and sentiment starts to get unusually bearish versus bullish, it's a good time to put money to work. And I think Wall Street's just catching up to a good economy, leading to higher interest rates.
Aren't you worried, though, David, that some of the stock market indicators are maybe questioning that good economy? I mean, when you have a rollover like we've seen in the industrials, in transports, in small caps, doesn't that signal to you that perhaps the Fed may be charting its path in terms of raising rates in spite of what the markets and companies are telling us this earnings season?
Well, I think this. If we watch what the economy is telling us today, we're not looking at what I look at to tell me that in the next year and a half, the economy would be just fine. That is real money growth, M2, still growing comfortably positive. I'll watch the yield curve, but I'll take the 10-year Treasury less Fed funds. That's a full percentage point advantage. That's quite positive. I think those are ultimately the most important gauges. I don't dismiss what the market is telling me, but with respect to the economy, and then besides earnings, look at cash flow. Companies are still growing their cash flow at 10%. Their free cash flow margins are quite healthy. That's telling me that there's going to be a big one, the 25% correction. This one is very unlikely to be it.